Hello and welcome to this week's episode of Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. I'm pleased to have two of my junior associates with me today as we do something that I haven't done before. Came up with the idea and I love the idea. And if I love the idea, then it has to be a good idea, right?
Yeah, of course.
Or at least if it was, but if it was my idea, it was a good idea.
Only if it works, right?
Right, only if it works. So here's what we're going to do. We're going to do a question and answer session. Okay. Now, unfortunately, I don't have people calling in. That would be the best thing. We don't have that yet. Hopefully, we're going to have it sometime in the near term. But what we've done is we've grabbed a variety of different questions that were either asked of us, that were asked in blogs, and all that. There's a lot of questions. So some of them may be applicable to you and some of them may not, and chances are a lot of them will be applicable to most people. And so what we're going to do today is basically go through it. So when I referenced my associates, to my immediate right is Ryan Keefe. Ryan's been with me for a few years. He is a CFP, registrant. That's the term.
Yes.
And so, he's sitting, taking his classes to get ready for getting his CFP. And for those of you who know, I have a tremendous amount of respect for the CFP designation. And then all the way to the right is Kyle Ryan, not to be confused with this Ryan. We run into that all the time. Fact of the matter is that Kyle did get a CFP, okay? Graduated Temple a couple years ago, got a CFP, and may very well be one of the youngest, CFPs or people that get the CFP that quickly, which is, says a lot about it because the CFP is clearly a advanced designation in this industry. So everything we talk about is all about financial planning, and fundamentally, everything comes down to the planning. Your 6 areas of financial planning are cash management, tax planning, which is not something you do at the end of the year. You're doing it throughout your life. Risk management, which is insurance planning. You got investment planning, you got retirement planning, and you have estate planning. So I imagine that these questions that keep popping up are going to probably touch upon these different areas, and don't be surprised if they're all over the map. So, you guys ready?
Let's do it.
All right, let's go. All right, first question, please. All right, what is the best way for someone in their early 20s to start making small, low-risk investments? Well, I'm not sure exactly what the small, low-risk investments are, so let's just call it, what's the best way for someone in their early 20s? Ryan, you want to grab that one?
Yeah, sure. So one thing you want to make sure you do as an investor in your early 20s, just when you're starting out, mainly you want to focus on what's my debt, and you want to pay that down.
Right.
Paying down debt is always important. In fact, it's kind of, if you think about it, a guaranteed rate of return. If your interest rate on your debt is, call it 8%, and you pay down that debt, you're guaranteeing that 8% return on your money. After you pay down your debt, you want to build up your cash reserves. You want to have enough emergency savings for, general rule of thumb is about 3 to 6 months of expenses. And then when you're ready to start investing, the easiest way to do it is through your 401k or your retirement plan at work. And what you want to do is find out what your company match is.
Yeah.
And then you want to maximize that company match.
Absolutely, it's free money.
It's free money.
Two of my favorite words.
Exactly. And then if you have any money outside of that, you might want to look at other investment vehicles such as Roth IRAs and things like that can help your money grow tax efficiently.
Right. And so, one of the things that I've always preached about financial planning is that you want to create flexibility. And, having an emergency reserve provides flexibility for emergency access to money. The 401k, obviously the downside of a 401k, the upside is that you're getting company match. The downside is, so long as you're still working for the company, you can't access it. And that's what's good about the Roth IRA. Right. When you have a Roth IRA outside of your plan, even if it was an IRA and a Roth IRA outside of your plan, You can access it while you're still working. And, as opposed to the requirements of the 401k, you actually have to leave the company. So,
And another thing I always tell clients is, understand your budget and pay yourself first. That's one way to start investing.
you know what? It's funny you say that. It very much is. And human nature, if you're making $50,000 a year, you're spending $50,000 a year. Okay? And then you get a raise and you're making $55,000 a year. Guess what? In no time, you're spending 55. And then unfortunately, if you go from 55 to 50, you're going to be complaining a lot, but before you know it, you're spending it. So the pay yourself first mentality is great because you're contributing to the 401k or whatever it is. And I'll be honest with you, when I first graduated college, if it wasn't for the fact that that they weren't matching, I probably wouldn't have contributed to my 401k. So anyway, that was a good start. All right, next question.
All right, so, looking at this question saying, you have a 401k, could you also start up an IRA? It's easiest way to do it is by differentiating the two. We have a lot of clients who come to us and say, I've got this IRA or I've got this 401k, when really it's the other one. So,
Right.
all the time. It's funny.
I know.
And, they're very similar. So the only real difference is one's offered through your employer, your 401k you get
Right.
through your employer, whereas your IRA is an individual retirement account that you open yourself.
Correct.
Custodian. So, the differences are really, in your contribution amount. You can put a lot more in your 401k. If you're under 50, you can put up to $19,500 currently in there, whereas an IRA you can only get $6,000 in there.
And the IRA is dependent on your income.
Absolutely.
So if your income is too high, you can't contribute to the IRA. You may not be able to contribute to the Roth IRA, but you can bang your 401k.
Yep.
And it's not income dependent.
Yep. You can get more into your 401k, but it's harder to access that money
Right.
as well. So that's
Exactly.
another thing you have to consider. If you're saving for retirement, you're not going to touch this money for a long time, and you have a lot to get in there. Well, yeah, you can do your 401k, and if you have extra, sure, go your IRA. And we haven't even really touched on Roths. Roths introduce a whole nother layer of flexibility. And
Absolutely.
Yep.
Absolutely.
Yeah, and one thing you also want to take into consideration with the difference between a 401k and an IRA is the 401k, you usually have a limited number of investment options
Yes. Yep.
that the company offers.
Yep.
So if let's say you really want to buy a certain stock or a certain mutual fund and your 401k plan doesn't offer it, well, too bad. The IRA allows you that flexibility to purchase that, sell that. And
Exactly.
do it.
Exactly. If you like Apple stock, you generally can't get it in your 401k, but you can get it in your IRA, Apple, Amazon, whatever. Whatever. That's a good point.
Yep.
All right, next question. How do I determine what is the right amount of life insurance to buy for myself? That is a really good question.
Loaded.
It's funny because I think the answer to almost every question, as we all know, is what?
It
It
depends.
depends.
There we go. So life insurance, really, all insurances fundamentally are to protect you from a major financial disaster. And life insurance, the financial disaster is, beyond the emotional impact, but I'm not bringing home a paycheck anymore. And if I have dependents relying on my paycheck and it's not coming home anymore, well then that's why you buy life insurance, to protect from that. And the two basic types of life insurance are term insurance and permanent insurance. And term insurance is just what it is. You're doing nothing but the bare bones insurance for a particular term, 10 years, 15 years, 20 years, or 30 years. Meanwhile, whole life or permanent insurance is one which builds a cash value, and they're structured with guarantees so that it doesn't pay if you die during that period, it pays when you die, which is typically more of an estate planning type of thing, because eventually if you're going to use it for estate planning, or you want to make sure that you leave it to your children or whomever, that's when you get the permanent type of policy. But if you wanted to get the biggest bang for your buck and you wanted to get the most insurance, the way to do it is term. And then the other question is well, gee, I can get it through work, which is group term, versus outside of work, which I refer to as being private. I'm generally a fan of the private insurance, okay? And the reason why the private insurance is because if the particular company that I work for offers me 3 times my annual salary, I could buy 3 times my annual salary. What happens if I leave that company and I go to another company that doesn't offer the insurance?
Yep.
Right.
Okay? And little do people realize that group term is age banded, which means that you're going to pay a certain price for if you're age 35 to 39, and then 40 to 44, 45 to 49. But everybody's lopped into the same category, where they only differentiate between male and female, and tobacco user and non-tobacco user. So if I am a male, sitting, and I'm a marathon runner, okay, and thin as a rail, and I'm a marathon runner, and I'm in great shape, I am going to pay exactly the same amount of money as the person sitting next to me who may be obese with heart disease and cancer. That's not fair, but that's part of the group insurance.
Yep.
And so otherwise, I'm normally a fan of trying to get the individual insurance because it provides you with the protection that you need, and you never have to worry about losing it through work. So how much insurance do you need was the question, and it really comes down to, it's a much longer question, and quite honestly, this is making me think I ought to have a show just on life insurance, because this could be an entire show. You can look at it based on trying to replace income, or what do I need to pay off all these debts and save for colleges. That's the capital needs analysis and the income needs analysis. So I don't want to beat this to death because this can go on forever. Next question. Should I get a reverse mortgage if I'm looking to retire in the next couple years? Well, I'm going to separate that question. In the next couple years is not really relevant per se. You don't see reverse mortgages all that often. And it used to be that they were really junky products, okay, and rip-offs and everything else like that. And apparently the federal government has begun to regulate them so that they're not junky products. But in short, what a reverse mortgage is kind of just that. If you think about a mortgage, I'm going to be paying, call it $1,000 or $1,500 a month for 30 years, okay, to pay off the loan. Well, a reverse mortgage is typically have the value of your home pay me a monthly payment. Well, who usually does something like that? Well, first of all, you have to be older. Okay, I believe the 62 years old.
62 years old.
You have to be over 62 years old. And what happens a lot of times is people who are older may not have saved enough for retirement, and they need more money than what either Social Security or maybe a pension or what their savings are providing. They need more money than that. However, they bought their house 40 years ago, paid $30,000 for it, and now it's worth $300,000. So what this does is it gives them the ability to use the value, the equity of their home, to subsequently pay them a monthly payment for the rest of their life. So I'm going to break at that question. We will be back with you in a few moments after our commercial message.
So, I'm kind of new here, but I've noticed a trend. My human does this funny thing where she goes around and gets all my toys, and then she hides them in that basket by the door. But it's always the same basket, and it's always in the same place. And then she acts so surprised when I find them, but, she's putting them in the same basket. Again. It's like, hello, that's where you put it last time. You were the worst at hide and go seek.
Welcome back to Financial Planning Explained with a unique episode here. I'm here with a couple of my associates, Kyle, Ryan, and Ryan Keefe. Here we are, we're just doing question and answers. So we got through a few in the first segment. Ready to shoot another one up. What's the next question? Which is the best way to increase my high income, large cap growth and risk allocation stocks? I do not understand that question. What's the best way to increase my...
Well,
Go ahead.
No, go.
You know, what I see this as is, you know, you're looking for high, I mean, the end word is stocks, so everything's stocks. You're looking for dividend paying, large cap growth, and target date funds. I'm not quite sure where this goes.
Yeah, you know, it almost sounds like they're asking three different things. So a high income, if you're looking for high income, then you're going to be wanting either bonds or high yield bonds. But typically stocks don't provide as much income because the opportunity is in the growth of the stock. And a risk allocation stock, maybe what the person is asking is something along the line of an allocation fund.
Yeah.
Right.
So I apologize to the person who asked this question. Unfortunately, I don't understand the question, so we'll have to move on to the next one. What's the difference between opening a custodial account and a 529 for our child's college fund? Kyle, you want to take this one?
Yeah, sure. I mean, really, if you're looking for a child's college fund, a 529 is built as a qualified education expense vehicle. So that could really be used to save from anything from college to high school now is a recent
Yeah, they
thing.
just changed that. It's a couple
Yep.
years ago.
So, you know, a 529 really depends on the purpose. If you know that your kid's going to be going to college, a 529 is the best thing for it. It's built for that. Whereas a custodial account, on the other hand, can be used for other things besides college. A
Right.
529 plan can as well, with penalties, but we won't cover that. A custodial account, you know, it's essentially, you can use it from anything for paying for college if you need it, or buying a car, buying your first house. It has a litany of more options. And
It's unlimited.
Yes.
It's unlimited.
Yep.
Okay, and it's considered to be in the child's name, and that's a big difference between a custodial account is, you know, like you heard of UGMA or UTMA, UTMA or UGMA. Basically, what that means is that a parent serves as the gatekeeper,
Yeah.
and the child can't get the money until they reach age of majority. And you know, Harvard versus Harley. Okay, well, if you put it in a 529 plan, then what happens is that the parents actually, or whomever deposits the money, is actually the owner.
Yep.
And not only are they the gatekeeper, the person who you have it for, the child, is the beneficiary.
Yep.
And so the beauty of it is that, you know, and we've had it many times with clients of ours that one child chooses not to go to college or doesn't use all the money, the parent can change the beneficiary.
Yep.
So it provides a tremendous amount of flexibility. It provides a tax advantage because the monies that you put into a 529 for college grows tax-free
Yep.
if used for college. And they just added the new rule 2 years ago that allows them to use up to $10,000 a year for secondary. Was it not secondary? Was it K through 12?
K through 12.
That's secondary, right?
Correct.
So what's primary? All right, next question. What's the best way to invest to have your money work for you? Okay.
There's a couple different ways you can answer this one. I mean, the best way to invest in and have your money grow and and that money build and then grow upon itself, in my opinion, is through dollar cost averaging. You know, you dollar cost average by, you know, there's no, you just pick an amount that you want to put into a particular fund, and it goes in on a, you know, timely basis, whether that be monthly, weekly, yearly.
Right.
And then, you know, what you're doing is over time, you're buying that fund or that stock at a low price, at a high price, and over time, you're averaging out the cost. And, you know, the more volatile that fund is, the cheaper it is over time, essentially.
Right. The average is always lower. It's a mathematical phenomenon, and it's basically because if the investment price is low, you're buying more shares. If the investment price is high, you're buying less shares.
Yep.
But I would think too, and this is also very difficult, and I apologize to the person who asked this question, is, what's the best way? I mean, certainly dollar cost averaging is a great way, but to have your money work for you, you would want to have something that grows more.
I would say, even defining, like, picking a goal for your money, understanding that, because if you want your money to work for you and you want to buy a house in 6 months, well, what you don't want to do is put it in the market and lose it. That's
Right,
not
absolutely.
how it works for you.
Right.
So really understanding the goal and the plan behind what your money is, the purpose of it.
Right.
Yep,
Yeah,
and from there-
unfortunately, it's a vague question, but as you pointed out, it all falls back to the planning. And when it comes to risk, time is the single largest component of risk. Even if I'm an aggressive investor, if I need the money in 6 months, I'm crazy to take risk for that because, we all know things can happen in a short period of time.
Weeks.
Oh, really?
Yeah, like as in like a 5-week, 35% drop because Mr. COVID decides to knock on the door. All right, next question. With dire forecasts of economic collapse and bank bail-ins, what's a bail-in? What is a secure option for saving with interest liquidity? Well, the reality of it is this. I'm not sure what this viewer is asking, and I apologize to this one too, but dire forecasts of economic collapse, I certainly hope that doesn't happen. Bank bail-ins, if they're talking about running the bank, that's been solved years and decades ago with the advent of FDIC insurance, which is up to $250,000 per
Account.
registered
Per
account. So
would it be fair to just recategorize this? I mean, what's in the headlines right now is inflation and economic collapse and dire forecasts. All I can think of is maybe they're referring to inflation.
Possibly.
So we could-
Because I don't know about dire forecasts of economic collapse, but we're in the process of having our fastest growth almost in the history of the United States. So
Yeah.
And one thing I would always keep in mind is, there's throughout the history of the stock market, there's always been predictions of dire economic collapse. And there's always been times of hardship, and
Sure.
no one can disagree with that. But the stock market has always prevailed.
Right.
So it's really just about your time horizon and how much you can stomach a loss. And if you need money at a certain time, you better have it safe
that's correct.
and not highly correlated to something that's volatile like the stock market.
Right, right. And so, all comes down to goals and objectives and planning first. And quite frankly, if it is short term and you need liquidity, then the reality of it is a savings account is the best way to go.
Yep.
Because there's zero risk. Unfortunately, as we all know, you want a high rate of return, you're going to need to take some risk.
Yep.
If you're not willing to take any risk, then you're not going to get very much return. And how many times in my career have I had $1 for every time I've heard, and I can't help but joke, of I would like a low risk investment that provides a high rate of return.
I don't want to lose money. I want to double it.
Right, exactly. But exactly.
Yeah.
I want to double my money, but not risk and lose
Yep.
it. Gotta love it. Gotta love it. Next question, please. My company claims we have a 401k loan program. How does that work? I'll take that one. Companies do offer a 401k. It is not a requirement to have 401k loan programs. However, many companies do. And I would say most do, because it's a provision that's allowed. It doesn't really cost the company any money. And if it doesn't cost them any money, then it allows them to have additional flexibility on behalf of their employees. Well, what a 401k loan is it allows the participant to borrow from the 401k up to 50% of their account value, but no more than $50,000. So if a person has a $200,000 account and they want to borrow, they can borrow as much as they want, up to $50,000. And what happens is they take the loan, and it can be determined as anywhere up to 5 years. And the loan payback is through payroll deductions. So rule of thumb, the 401k loan, interestingly enough, if I took a distribution of a 401k, what happens is that I get the $50,000 and it's not taxable to me. So I literally can take that money, put it into an account, do whatever I want with it. That money is not taxable. But now that loan is a loan against myself. It's against my own 401k. And so I end up having to pay interest on that loan. But the good news is that generally speaking, the interest is relatively low. Okay, I want to say 4 or 5% in today's interest rate environment. But better yet is I'm paying myself the interest. Okay, now the problem is it is double taxed. But if I took a $50,000 loan out and I was doing it at roughly 5%, whatever that rate might be, what I would find is that my monthly payment is about $900 or somewhere around $400 to $450 every 2 weeks. And so by the time I get done paying back the loan, I will have paid my $50,000 back, but probably another $5,000 worth of interest. And so the downside is that I actually took after-tax money, put it back into my 401k, and I am actually getting double taxed on that money. But I would much rather pay tax on that money than give that money away to a bank. But the problem is too many people look at that as easy money, grab the money. You're taken away from your retirement, and we don't encourage it, but it may actually be a better solution than other really bad solutions. Like taking $50,000 against a credit card at 25%. Okay, that's not a good solution. So, all right, well, that's the most amount of questions we can get in today's episode. So what we're going to do is we're going to continue this on for next week. And so stay tuned. Appreciate you tuning in. And stay tuned for next week's episode where we pick up with the questions and answers. And we'll see you next week on Financial Planning Explained. And I'm your host, Mike Menninger, Certified Financial Planner, with two of my teammates here, Kyle and Ryan. So we'll see you next week where we pick up where we left off.